Welcome to Fintech Impact. This podcast is an exploration of the financial technology world, interviewing different fintech entrepreneurs about what they do, their story, and what their impact is on consumers, incumbents, and the industry as a whole. Here's your host, award-winning financial planner, university lecturer, and writer, Jason Pereira.
Hello and welcome to Fintech Impact. I'm your host, Jason Pereira. Before we get started with today's show, one quick announcement. I actually serve on the board of an association known as the Individual Finance and Insurance Decision Center, and we're hosting our 2018 conference this year on November 6th between 9 and 12 at the DeGroote School of Business in Burlington, Ontario. The theme this year is new developments in fintech and their impact on society. We will have topics ranging from crowdfunding and societal impact to the role of alternative data and AI in fintech lending, to initial coin offerings and the performance of them, and legal risks of blockchain. For those of you interested in attending, I will make this information available on my LinkedIn site. So, moving on to today's show. Today on the show, I have Gary Baker. Gary is the COO of Cannex. Cannex is, we'll call them one of the OGs of fintech. They've been around for 35 years, and they're the largest player in the space. So what Cannex does is they provide quotation, analytical, and quantitative data surrounding annuities and term deposits. And with that, here's my interview with Gary Baker. Good morning, Gary.
Good morning, Jason. How you doing?
Good. Thanks for coming in.
Thank you.
So Gary Baker of Cannex, tell us all about Cannex.
Well, Cannex, it's about 35 years old, founded in Toronto. We now operate in the U.S. as well as Canada.
That's as old as a fintech gets.
Right, exactly. Well, actually, before fintech, maybe.
Yes, there was no term for it back in those days. Yeah.
And it was started by Lowell Aronoff and Alex Melvin out of Lowell's apartment. Basic premise of Cannex was to provide a one-stop shop for annuity pricing, if you will. So that has grown from then to today, where we really provide pricing and analytic services for retirement savings and retirement income products. And with that, we have a team of actuaries and a team of quants, as well as a technology team, primarily based in Toronto. But we also have employees in the U.S., and we serve really the financial services industry as a B2B business.
So before we get into the actual business, let's just go over your personal history. How did you come to be where you are?
Sure. Well, I joined Cannex about 8 years ago. My prior experience was about 20 years with GE Capital, primarily around product management and marketing, and held a variety of positions both in North America as well as internationally in a variety of line of businesses, and ultimately ended up with the insurance business of GE Capital, which was the part that eventually became Genworth when they IPO'd that out in the early 2000s. And then from that, moved over to Mass Mutual for about 5 years, where I headed up product and marketing for their retirement income business. And it wasn't until really 2008, when a lot of change was happening in the industry, I had the
You could put, that's putting it lightly.
Yeah, well, there were mushroom clouds going off.
The world was ending, yes.
And so a lot of people were affected by that. In my case, it provided an opportunity for me to move over to something that I always wanted to do, working for a small business, and as opposed to a Fortune 50 business.
All right. So let's get into the various lines of business. So you break them up specifically into kind of two segments, correct? You have I'll let you talk about that.
Yeah, sure. As I mentioned, the one segment I'll put in the category of retirement income, which really revolves around annuities and how annuities are placed within financial plans. And the second category would be savings products. And for that, although annuities can be positioned as savings products, we also support the pricing of funds, mutual funds out in the market in Canada, as well as term deposits and also loans from banks. So with that, in the U.S., we're primarily focused around annuities. In Canada, we're much broader in facilitating the pricing and exchange of that information across a wider variety of products.
So let's deal first with the banking and pricing side, because I think that's the easier one to nail down. I think we're probably going to talk a lot longer on the annuity and retirement side.
Sure.
It seems like it's the more compelling conversation too. But I mean, for all intents and purposes, I was first familiar with you guys as being kind of the quotation service for GICs or term deposits and annuities. So basically I go on to one place and I'm able to shop the entire market for best rates based on that. So pretty much almost a big data play, data aggregation play, and you pump that out to the market. So in general, your market there, has it been predominantly advisors or has it been institutional? How's that worked out?
It's both, really. Ultimately, the premise of the business is to provide a central exchange for brokers to sell third-party products. And whether that's on the annuity side or on the term deposit side, it just becomes more efficient for that advisor to go to one spot to get today's pricing so they can do the comparative or the evaluation on what's best out there today. Staying with the term deposit side of the equation, as we're talking about now, when we started the business, a lot of what we do revolves around the strength of our platform, how robust it is. In fact, there's probably the two largest investments we make as a business is number one on technology in our platform and number two, research and development. But in getting the annuity operation up and running initially as a startup, about 10 years after that, we found the opportunity to leverage that annuity platform or the infrastructure that we built to also do these other things in the Canadian market, specifically around term deposits. So you could say it was opportunistic to leverage what you've initially built to kind of branch out and apply to different aspects or different financial products at that point. So with that, there was an opportunity to fill a gap that was there in the term deposit market to really be a central clearinghouse or exchange, not only for the pricing of those GICs, but also our Cannex financial network allows for the accounting, if you will, between independent brokers and those banks or credit unions to help facilitate those transactions every day. So it was taking our tomato farm and making some ragu out of it, if you will, and maybe some tomato juice. And it was a great opportunity, and it's worked out really good for us.
So two interesting follow-ups to that. So you say you're facilitating transactions. So what does that mean exactly?
Yeah, so what that really means is that an advisor or dealer who has multiple advisors during the course of the day, they may sell quite a number of GICs across a number of banks and credit unions. At the end of the day, the dealer will aggregate those transactions and then send us a file of which then we store that, and then we redistribute that information and repackage it back to the manufacturers of those GICs so that they can, in a much easier way, get the full accounting of who sold what across the Canadian
you're becoming
market.
The exchange, essentially, for lack of a better term.
Right. And so from that, then it greatly it provides a lot of efficiencies around the clearing and the exchange of the funds, if you will, between the dealer and the
I'm not surprised when that was deficient, given that it's such a antiquated line of business, right? In terms of how far back it goes and still predominantly paper based and whatnot. So not surprised at all that there was an opportunity for you to insert yourself there and make yourself the facilitator of that transaction. Good. So in terms of the actual data acquisition, so where are these rates coming from at this point? I'm assuming that everybody's decided to offer it up to you guys as a means of actual competition, or are you still having to extract some of this the old-fashioned way off of websites? Or
No, I think one of our key values or tenets of our business is that work directly with the product manufacturers, and they will actually automate it on an automated basis, or in some cases in the old days, Post-it notes, but they will feed us the information directly. And there's a value for them to doing that because obviously they can get access to the whole network of rates for competitive intelligence. But it really goes back to our annuity business as well, where we want our distributors, the distributors that we support, they want the assurance that what they're seeing is correct.
Absolutely.
And real. And there's no other way to really do that unless you're working directly with the carrier. And then working with the carrier or the issuer, you want to provide some value back to them as well in return for working with our processes. And we validate and test those rates to make sure they're correct so that when the dealer receives them, they know it's right.
I mean, it's such a highly competitive, commoditized market in many ways that I can see why they would facilitate that. Because, I mean, you look at some other lines of business where, specific types of insurance, for instance, where they're actually almost reluctant to do that sort of thing, and almost think of again, barriers to entry as being kind of a strategic advantage. Friction is not something they want to eliminate because they think that's going to more likely lock in the client, but is what it is. So it's interesting to see that some areas they totally get the openness benefit of it, and some others they resist. But
well, Jason, you bring up a really good point, because ultimately our business model is driven by the need of the broker and
absolutely.
the distributor.
And the need of the client when it comes down to it.
Sure, absolutely. And they want the assurance that what they're seeing is the right thing, so they don't get all wrapped around the axle and trying to complete the transaction. So with that, especially the larger dealers that we work with, they're the ones that go back to the issuer or the carrier and direct them to work with us, because they know that we have the robust platforms and the processes in place.
As the carrier wants to play, they got to basically plug in.
Right. So that essentially the distributor is the one that's instructing the carrier or the issuer to really work with us and work with our processes through our clearing system.
You've effectively become the platform for aggregation.
Right, exactly.
Excellent. Good. So let's move on to the annuity business. Now, this presents some very unique challenges, I would think, given the esoteric nature of contracts across the board, especially in the US. I can't imagine the daunting task it is to try to basically fully understand all these things.
Oh, yes. In fact, that's really where we come into play. As I mentioned, one of our big points of investment is our technology platform. Of course, that includes information security, because we're tying into banks and all these things. So as a result, we have to be just as secure. But the second point of emphasis and investment that we really focus on is research and development. So even as recently as 2013, we purchased Moshe Milevsky's research business.
Oh, yeah. I'm always happy to plug his name. For those background, just friend, mentor, colleague, former professor of mine. So there you are, Moshe. You got your plug.
Well, what that did is provide us the ability to bring in the additional ability to deconstruct and reinterpret what you would consider very complex products. Income annuities, both in Canada and US, are pretty simple.
Single premiums are pretty straightforward.
Right.
Commoditized market, it's very easy to quote those. There's not a lot of differentiation between them. So
right.
Yeah, you're plain vanilla. Basically.
So we did very well with that. Now you can imagine with that type of infrastructure, that's also why it led us to get into term deposits too, into some degree. Different product, but
similar, kind of commoditized, straightforward.
Right. But in the US, that's only 5% of the market, annuity market. The other 95% of the market are what you would refer to as deferred annuities or savings annuities, which are essentially structured products that could be considered rather complicated.
That's putting it lightly.
Right.
Depending on the ones I've seen. I mean, some of these contracts I've tried to dissect and really?
Yeah.
How do I price this?
Exactly. Well, and sure enough, it's not only is it confusing to the consumer who's considering these contracts, but it's similarly confusing to the advisor who's trying to figure out which ones could provide the better benefit. And
that's why they get a black eye, unfortunately, is all this complexity, which basically it's hard to when you have a really beneficial complex product, it's hard to relay that from the ones that are just not that beneficial and complex for the sake of obfuscation, right?
Right.
So I often feel like the complexity that they add to this industry is actually detrimental because it prevents, creates a market for the Susie Ormans and everybody else in the world to beat them up and call them evil.
Right. And, you bring up a great point because that's exactly what we're looking to solve for with what we do. We want to provide transactional transparency. Mm-hmm. So what happens is the Susie Ormans of the world or advisors or even, other folks out there, distributors, they want the insurance companies to make things as simple as possible. Mm-hmm. They hate the complexity, and they essentially want the insurance companies to dumb down these products so that they're more accessible, maybe more understandable. The rub there and dilemma, or the catch-22, is that in order for insurance companies to deliver the best value, whether it's a death benefit or an income benefit or the accumulation portion of the contract, which by the way, is all wrapped up into one product, if you will. You can almost argue it's a Swiss Army knife.
It really is. I've seen some of these things with 12 different additional rider benefits that change it dynamically in so many ways.
Right. But the reality is they build them this way not only to try to extract the most value as far as where they want to compete, but also gives the advisor the ability to then pick the specific option that fits best with that client and that plan. So there's this tug of war between the market wanting simplicity and the carriers trying to deliver value. So what we do is through our analytics on top of our core platform, we can basically pull the marketing story off of it and then quantitatively provide comparative illustrations and scores as to which contract or which component of the contract will perform the best depending upon that specific client situation.
And in fairness of pricing as well, which is no doubt a challenge as well. I mean, in a personal story and how I first met Moshe in his class, I wrote a term paper on the pricing of guaranteed income products in variable contracts in Canada, which later got published, not academically, but nevertheless got published in the industry. And it was, the math behind that is actuarial. It's hard to understand. And the average advisor doesn't stand a bloody chance, right? And of course, I was publishing that saying, hey, these things are actually underpriced. And everybody else was basically publishing articles saying these things are fraudulent and criminal. And meanwhile, time has proven me correct. Not only did a couple of insurers in Canada almost go under because of these guarantees, but some of them are trying to buy their way out of these guarantees. Right. So it's quite hilarious, but it's a real challenge. I mean, the advisor does not have the skill set to basically properly value whether or not what they're paying for is actually worth it for the client, right? I mean, you may say, here's the story behind when you use this, but is that a fair price? price.
Sure.
So that's, I guess, one of the ways you guys come in. But that being said, like I said, I'm kind of daunted by the complexity of all this. I mean, that's contract by contract that you guys are going, right?
Right, exactly. And that's where the partnership with the carriers come back into play. It's really important for us to have a very good relationship with the people who build these products, so that their actuaries talk to our actuaries.
Yeah.
We're able to basically...
That must be such an entertaining conversation.
Well, you should see the cocktail parties. It's even better.
Oh, lovely. Politeness cocktail parties. What's the old story? The definition of an outgoing actuary is one who looks at your shoes when they're talking to you?
Right, exactly. Yeah, and those are the type we hire, by the way. So.
No, that's all right. I love actuaries. I got many friends who are not the most interesting people, but no, they're great. I'm kidding. Continue. So to date, I'm curious, how much of the U.S. market do you think you guys have captured in terms of the players in this? Have they all opted in, or?
Yeah, that's a great question. We've been building out this platform now operationally for the last 2 years. So the easy part's the methodology and the processes that we put together to deconstruct and then put everything into an apples to apples environment, if you will, or in as far as a format, if you will. The tough part has been building the systems and the processes which will allow us to be more efficient in programming these products into the platform. And most importantly, to allow our clients to configure what we provide as an industry utility into the processes they want to deploy this pricing. So they just don't deploy this at the point of sale where the advisor is quickly evaluating one product versus the other to place the contract. We take this information and what we do, and we can also support the compliance department at the firm who may want to look at different elements that we produce. Or we feed financial planning tools through APIs, if you will. Also for research and development, even for evaluation of in-force business. So again, we don't provide just one path into what we do. Through our platform and us acting as an industry utility, we want to be as flexible and configurable so that whether it's the distributor or the carrier or even a service provider who does financial planning tools, they can take what we have and apply it into their own process and increase the value of what they do.
Excellent. So tell me about the APIs as they feed into financial planning tools. Like, what's the functionality there? Like, what to date have you seen people build off of what you provided?
Sure. Great question. It can be a variety of things. So one example would be a financial planning process where they're trying to figure out the appropriate allocation, not only between equities and bonds in a portfolio, but how much of a floor guarantee for income they may want to also account for by using an annuity. You can almost say annuities position as a super bond, if you will, in such a retirement income portfolio. Yeah. So what they do is to kind of gauge how much of a floor to build within that portfolio. We'll feed them real time through XML, either the average of the top guarantees in a particular annuity category or a specific annuity so that it's fed into the allocation process within that tool.
So instead of the advisor saying annuity is going to make X, you're taking real-time data, plugging that in there and doing an optimization between traditional market segments and the guaranteed income.
Correct. Yeah. So then they can do what they do best, if you will. Now, that being said, back to our research group, I would have to say that we also, through our acquisition of Moshe's business, we also manage optimization engines for allocation.
I'm very familiar with those, but we'll talk about those in a second.
Sure, right.
I am a customer.
But another example of our relationship with financial planning tools are that in some cases, those optimization engines on the tool side, they may go as far as making their own capital market assumptions or assumptions about guarantees in general. They'll then come up with an answer on how much you should put into a particular annuity. Yeah. And then they would feed that information immediately downstream to us so they can immediately see which contract would be the best purchase given that allocation decision. Yeah. So it really depends upon how the service provider wants to stage the process.
I was going to say that's where the variability comes in because, I mean, we can get two completely different results just based on assumptions on not just even returns, but correlations of returns and whatnot. So it's a real challenge there, but it's...
it depends on whose black box you use.
That's exactly right.
And when we do comparative illustrations on these products, part of the value of what we do when we program the rules and parameters and algorithms of these products on our own platform, we're using a single black box. And it's our Cannex's black box. So we're putting the same electrical current through every insurance contract.
For a guy who worked at UGE before, that's a good point.
Exactly.
Yeah, there you go. So good. So let's talk about your previous company. It was once called Quima. It is now your quantitative division. Can you tell me about the lines of business there and what that does?
Sure. A few things. So we In addition to helping support concept development for our core services and what we do in the valuation of these products and different ways to compare them, we also look at new to the world concepts or retirement income concepts. In other words, things that may not necessarily involve an annuity as far as what's the optimal systematic withdrawal rate out of investment portfolio by using annuity-like methodology and concepts, except just applying it into the investment-only world. You're using the basic same fundamentals as far as how you're looking at a client situation.
Bringing longevity essentially into the equation and factoring that into the portfolio decisions.
Exactly right.
Absolutely.
So we have a research paper coming out on that in a few months.
Forward it to me, please.
But as I mentioned before, if you are going to incorporate an annuity or some type of insurance guarantees into the portfolio, we also run optimization and our own methodology for the allocation of assets across investments, annuities, life insurance, or anything else that you would want to consider in the portfolio. Again, using similar methodologies, we create an efficient frontier. Instead of risk versus return on the investment side, the axes are basically, do you keep the money or do the kids get the money? And then you optimize across that spectrum.
Absolutely. So tell me, in terms of these, these are concepts that I absolutely use and embrace, but that's because of who my professors were. But that being said, I'm curious as to how much you see this implemented across the board, both in Canada and the US, because it's enough to, I'll tell you, the number of advisors to this date I still see who fail to adopt even a modern portfolio theory approach to management already. And then you start throwing in longevity into that and creating a third parameter that has to be contemplated. How much do you see this adopted thus far?
It's interesting. In the States, there's a lot more focus and activity around having advisors get more engaged in this type of process. And I say process because of the regulators and even what the Department of Labor had done previously, but now you have the SEC, NAIC, and other.
Yeah, it's not going well.
Well, what they're doing is essentially they're moving people away from a product sale into a process sale. And which, when you think about it, it's the right thing to do.
100%. Because even if you're selling a product, there should be an underlying empirical reason for why said product's getting sold, as opposed to, 3 times your income. Just absolutely.
Right. And so as a result, the distributors, the advisory firms, even 401k platforms that do planning and support to the participants, they are more focused on providing those tools so that on a fiduciary basis or semi-fiduciary or whatever along the spectrum you find
yourself. Depends on which branch you're licensed under, I'm well aware.
Right. So that they're doing the right thing and they're covering a basis so that they're not focusing on one product versus the other without going through that process. You could even argue that for advisors who have traditionally not sold annuities, by going through a process, they're now obligated to potentially look at an annuity, especially if they're trying to figure out a systematic withdrawal plan.
Fantastic. A number of times our biases come into play, right? And a number of advisors are like, I don't use those. I'm like, well, what if you have a client who's absolutely the perfect textbook fit for using that solution?
Right.
Well, you can't be an expert at everything. I don't use those. And it's like, it's not about you.
Right.
So, that's the fact that you're pushing people into a process that gets hopefully some of that human bias or prejudgment out of it would be usually valuable.
Right. And then on the flip side, looking here in Canada, I would say it's somewhat quite behind than the activity that's going on. In fact, when you look at the websites and even from the large institutions, whether it's the big 6 or 5 or 6 or other distribution firms, you really don't see a lot out there with regard to retirement income tools or guidance. In fact, it's...
Or fiduciary standards, or I could go on for about an hour about this, but yeah.
So I think that's a big opportunity where the market in Canada can catch up.
If there's any will to catch up, unfortunately. So we'll leave that, put a pin in that argument and walk away from it because I can go on. Anyone who wants to hear that argument, there's the Plan Plus, a previous episode where Sean Brayman and I go off on a tear about that. So if you're interested, by all means, listen to that one. So, okay, great. Last one other product line that is kind of mentioned here, kind of buried everywhere else, you're benchmarking and indices. Now, let's talk about that because we're not talking conventional benchmarking and indices. What are we talking about here?
Well, we're talking about indices that provide a context for advisors or even consumers, but I would argue more advisors, to make an informed decision around whether or not a systematic withdrawal process would outperform putting some money into an annuity. So there's a few indices that we do. One indice that we produce is called a pay index, so that it gives you a sense at any particular day or month, what your cash flow return would be coming out of an annuity on a guaranteed basis for certain ages and deferrals, so that if you're thinking about the 4% rule of thumb for withdrawal for your client.
I hate that rule of thumb.
I'm just throwing it out there for simplicity.
For those of you who don't know where that came from, it came from a study. It wasn't the S&P they looked at, and it was what was the minimum sustainable rate over the entire history over the S&P, and it was 4%. I'm like, congratulations, you did some back testing. Like, that is not an empirical standard, and it is not some sort of universal constant like the speed of light. Like, we get away from that, people.
So please, I don't recommend that one either. We also had advisors that asked us, what's the internal rate of return of this product? And which is kind of like asking an apple and orange question, because
longevity is the variable.
It's the variable. You got 3 modes of return in annuity. You only, in a financial, investment product, you get either principal and the return, the investment. In annuity, it's 3. You get 3 flavors of return. You get the principal, the interest, as well as the longevity credit.
Yeah, and then on top of that, you have the tax implications of it, right? They're very, very different in Canada and the U.S. So you have the deferral in the U.S., and we don't get that in Canada. And then you also basically have levelized. They basically both do prescribed payouts, but the U.S. prescribed payout ends at the point at which your capital is returned to you, right? So it's, in Canada, we just get to keep on taking that prescribed credit, thankfully. They changed the rules and they're not as good as they used to be.
Yeah, but actually, and one final indice that I want to point out, I think is really neat that we've been doing over the last few years in the States is we do an income annuity yield curve. And what that yield curve is used is for carriers to do a market valuation of annuitized assets. So the issue that was presented about 10 years ago in the market was that the gorilla in the room was an advisor working for a bank or a wirehouse may have been disincented to sell an income annuity.
Oh, what a shock.
Because guess what? Once you put that money in contract, that money for that client disappears from the AUM report.
Oh, I'm well aware of that conflict.
So
same reason why a lot of universal life or whole life policies are not sold in broker-dealer channels, especially through banks. It's because they don't want to see their AUM go down.
Right, exactly. So as a result, in the category of doing the right thing, a lot of the larger banks decided to really look to a way to provide a market value of that asset that was annuitized so they can place it back into the AUM report so you still have a clear picture of the amount of assets you're really managing for that client. So
is that an initiative in the U.S.?
That's a U.S. initiative.
I was going to say, I've never heard of that in Canada.
So what we do is instead of using the treasury curve for the carriers to perform that valuation, that market valuation, because carriers are doing statutory valuation.
But you can't do that with you can't factor in the longevity credit based on the treasury.
Right. Numbers. So what we do is because of our platform, we can backward solve for based on actual pricing on our platform, what the crediting rates are across those terms and match it against the U.S. Treasury and provide them a unique yield curve so that they can go ahead and do the market valuation and then feed those values back to the banks to place into their AUM report, and they do that on a daily basis.
Interesting. I like that. I mean, it's a nice solution for a problem that shouldn't exist in the first place because we should just do the right thing. But nevertheless, anything we can do that eliminates a conflict of interest is something that I'm very happy to see happen. Be happier to see it happen north of the border, but I can only hold my breath for so long before I pass out. So here's an esoteric question for you. The annuity puzzle. I don't think there's a puzzle. I think I have my own answer to it.
Right.
But in terms of especially your views across 2 countries, what do you think the holdback is with the adoption of these products to greater rates?
Well, I think it's not so much pricing or low interest rate environment versus high interest rate environment, which you could also say that's a hogwash objection.
It is. At the end of the day, the price is the price and longevity is what matters, and what you're going to get. So,
right. Yeah. But I think ultimately, in my personal belief, it gets back to psychology and behavioral finance. I mean, if you talk to any financial advisor, such as yourself, they would even say, my practice is 90% psychology and maybe 10% the numbers.
I always say that the tissues are here not for returns, but for what happens in people's lives. Yeah.
And people, we've been involved in a lot of research, and we do research every year with Greenwald and Associates, both in Canada and in the U.S., to kind of gauge not only how consumers value these guarantees, but whether or not they understand them. But they want something like Social Security or the government support of a guarantee.
Everybody
but they don't want to buy it.
Exactly.
They will love pensions, but they don't want to buy it with their own money. Yeah. And they don't want to give up control. And that aversion to lack of control not only sits with the consumer, but also sits with the advisor at some point too. So I think really it's positioning and framing the purchase of an annuity. And that's where we come back to the process. If it's a product sale, it's never going to get off the ground. But if you position it as part of a process and say, look, this is another piece that you put into the portfolio, then that framing and and overcoming that behavioral barrier becomes a little easier.
Yeah. And to me, it just comes down to sticker shock. I mean, that might be the single largest check these people cut for anything other than the house, right? Like you tell someone, I had a case that comes to mind. It was $1 million household and basically did the math utilizing your tools and, double checked it and on the financial planning software and found, what optimal scenario is let's take $320,000, part that in an annuity, joint last to die. And, your longevity, your probability of success on Monte Carlo and longevity tests basically goes to the 90s, right? So the odds you have to do something are sub 10%. No, they just would not go for it. The idea of turning over $300,000+ in one check of their life savings was just not going to go. Right. And it is what it is. You can't get past it. But it's behavioral. But again, the entire thing, it's hilarious because you ask them the question, if you could buy into this well-known pension plan, how would you do it? And like, oh yeah, I'd love to be I wish I was a member of that pension plan. You give them the option to do it themselves and they're just like, oh, hold on a second. Like it's not I often said if some of these pensions got into the annuity business themselves, they'd probably do very well.
Sure.
Yeah. Although they don't want those obligations. Like that's not what they're there for.
That's why they invented insurance companies.
Yeah, right? Exactly. Especially in the US where they're just desperately trying to get rid of the obligations. Yeah. So basically, what are some of the major challenges you guys encounter in doing what you're doing? It sounds like the carriers have been pretty good at working in collaboration with you. So where are the roadblocks you're seeing?
Well, a couple things. Getting to your point, it's not a slam dunk with the carriers, and we're working more with newer carriers. And in some cases, it's a love-hate relationship, they'll tell us. They say, we love you guys and we hate you guys. We love you more than we hate you, but
you're helping us with business through transparency.
As they grit their teeth and bite their lip, right? Yeah. So, but at the end of the day, it ends up well for them when they do. And for what we're doing, we feel we're doing something new and different in that when you're trying to support the rationale for placing an annuity product with a client, and there's, again, a lot of compliance and regulatory elements that go into that as far as what you put in the client file and what have you, what we're trying to do is solve the last 10% of that due diligence, if you will, to make that recommendation bulletproof through the quantitative analysis. In other words, you can look around for the best rate as possible, but if somebody
that's one dimension due diligence, that's not the full story.
No, right? Exactly. If they like the Sun Life logo and that's their decision to buy a product, and as long as that's documented in the client file, and based upon today's regulatory environment, okay, well that fits the bill. But the reality is, what is the best economical decision for the client, and what we can do by a transactional platform that can do comparative illustrations and prove out the quantitative element of that decision. We're just adding another layer of bubble wrap, if you will.
Absolutely. But it's so necessary because, not just from what I believe is a moral standpoint of making sure your due diligence, but you're completely on trend with the global trend towards basically professionalizing this industry and making sure that we're not just working off rules of thumb like 4%, or we're not just basically working off what we think is the best thing, but there's actually a quantifiable reason behind it that backs our decision. And that's something that, frankly, we not only owe it to ourselves as professionals, but we owe it to our clients in general in order to do the best job for them. And hopefully that eventually becomes actual law, because sadly needs to become a law, but it is what it is. So one last question I ask everybody before we wrap up every time. So what excites you most about what you're doing in terms of like what's getting you out of bed? What's the most exciting thing about your industry, your job, your position, this company? What is it that fuels you?
I think we're making a difference. I think we can help the industry get through its challenges in selling and positioning annuities to do the right thing. And whether we're working with a regulator or an advisory firm or the carrier or a university for that matter, as they're looking to train and establish programs for financial planning.
Okay, we're going to talk about that before you go.
Yeah. I think there's been a real gap around this. Nobody could really get a sense of how the performance of these, again, somewhat complex products, how they would actually perform through a independent evaluator such as ourselves. Now, we're not Consumer Reports. We're not gauging whether something's a 2-star versus a 5-star.
Yeah.
But like I said, we're we're providing a platform, whether it's our assumptions or it's your assumptions, that you can plug through the equation and get a sense of really what's the miles per gallon of this car. It's one thing to go shopping for a car and just look at the curb weight and how many cylinders it has and horsepower and how many cup holders. But that's not going to tell you how it's going to perform. What we do is provide that number, which is the biggest number on that whole sticker, which is the miles per gallon.
And it's such a challenge because the only number that people have to date is basically the cost, is the fee, right?
Right.
And oftentimes, and I've seen it from experience, the first thing that an advisor in competition is going to do is they're going to go after the price, right? Because typically, unfortunately, most of them don't have a really good value proposition. So in the absence of value, cost is the only thing that matters. And you may have bought this fund with the higher cost for a very tangible reason, right? A very beneficial reason to the plan, everything that we've just talked about for the last half hour. And it kind of opens up a blind spot for attack, right? To the lesser educated advisor or more nefarious ones. So being able to not only back that up, but fully build up the diligence and create the real reason and the real scientific backing for why you're using something like that, frankly, is exactly the way the industry's got to go.
And what I would just add before we move on to the next question is that what you'll see and what we show is just because one product is more expensive than the other doesn't mean it's a bad product. In fact, it provides most often the better value. So it's not so much of making a decision of the cost of one product being the higher than the other. The decision is whether or not I'm going to buy a Ford Taurus or a Cadillac.
Yeah. Absolutely. And I totally get that. And it's nice to see tools being developed to help explain that value proposition and actually quantify that value. So thank you for that. So normally there isn't another question, but you mentioned something about universities. So I'm very curious about this. You guys are working in conjunction with some universities on developing curriculum around this? Is that the case? Or just tools around it?
We make our information available.
For academic research, I get that.
For academic research.
Moshe's not going to let you not do that, but go on.
Exactly. Right. But universities such as Texas Tech, for example, they have a financial planning program, and we make our platform available to their students as a resource for some of their research and information they're trying to gather for that purpose. So ultimately, we're trying to help the whole industry. We want to see the whole tide rise, if you will, and we think having more accessible information at the point where somebody's not only at the university trying to get a gauge that there's this thing called an annuity and this is how it works, but another area that's been a real barrier in our industry is the lack of education around accreditation programs. I would argue that the CFP designation, there's probably, out of the volumes and volumes of information that you have to study and take an exam for, there's probably a little insert on page 47 on what annuity is. Now, I'm overgeneralizing that, but there ain't a lot of focus on a lot of those programs in positioning annuities as part of financial plan. I think it's getting better, and there's other accreditations coming out, but I think that's another area where that needs to improve.
Agreed. I mean, having taken CFPs on both sides of the border and the CFA, part of which was written by Moshe, so I heard his voice while I was reading it. I'm seeing that start to happen, start to change. However, it's still very, very minor. And I kind of get the delicate balance they're writing with that. It's, they're not going to get into something that could be a volume in itself. So it's a challenge. And for those of you in Canada who aren't aware of this, but you can actually get a PhD in financial planning at Texas Tech, which when I heard that, I was like, what? But that's definitely, it's interesting to see the concurrent development on how the academic body of work is happening on both sides of the border. So very excited, and thank you for contributing to that because it's sorely needed. So Gary, thank you very much. This has been great. And any last thoughts or comments?
No, thank you, Jason. I appreciate you having me.
No, my pleasure. Take care. So that was my interview with Gary Baker, and I hope you enjoyed that. Not too often you find a fintech that's 35 years old, but it's kind of nice to come across one of the older ones from time to time. And just a reminder again about my LinkedIn page and the link to the iFit conference. I will also include that in the show notes. And with that, this is Jason Pereira signing off from Fintech Impact. Until next time.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at fintechimpact.co.